Since it's a stock rights offering, again, keyword rights, you have the right to exercise it, but you also have the right that you can also not exercise it. You are not compelled, you are not obliged to be able to get it. If you're looking at your shares from a, say, like a pizza pie, if you don't exercise it, your stake becomes smaller percentage wise, because those that would exercise it would now have a larger stake, the much larger pie. Hey guys, so I've made so many videos about stock rights offering, but this is something that has been a recurring theme. I've gotten a lot of messages asking me about the stock rights offering for Globe. Ultimately, the main goal of this is not to tell you if it's worth buying or not, or if it's worth subscribing or not, but the main context of this is to help you know what it is, so that you can decide on your own also if this is something worth getting into, and if this is something that you should actually invest or you should actually pursue as an investor. SRO, stock rights offering, by the entire acronym, it talks about rights offering. So if you look at the general context of it, the only people who get to be involved are people who currently own shares, and regardless of what exchange you're actually looking at or you're actually investing in, there's a snapshot on a particular date that shareholders on this date get to be able to exercise their right to be able to participate in the stock rights offering, because it's only given as a privilege to people who already own the shares. If there's a market price, the SRO always lower than whatever the market price is. So in essence, this is the company, in this case Globe, giving a chance to current stockholders who believe in the company, want to be a shareholder, to purchase it at a lower price. People may say that it may seem unfair because this is the market price. Why is it selling at a discount? That's why it's only for a select number of people. It's only for the current shareholders. And there are different ratios to a stock rights offering, but what it just normally says is this: depending on the number of shares you have and depending on whatever the ratio is for the SRO, that's the number of shares that you can get based on the number of shares also that you have. The more shares you have, the larger the number of shares also that you get to exercise during that SRO. So please do note that for SROs, it's not for everyone. It's only for people who own current shares. You can't also get more than what will be allocated to you based on the number of shares that you have and based on the ratio that will be given for that particular SRO. SROs are given to stocks that are already in the market. So since they're already in the market, you can buy them readily with its current market price. The lure for people to be part of the SRO or to exercise and be part of the SRO are for those who want to buy it at a lower price. That instead of buying it today at this current price, why not just subscribe to the SRO and get it at a lower price with the multiple, or at least the ratio and proportion of the number of shares that you have. Since it's a stock rights offering, again, keyword rights, you have the right to exercise it, but you also have the right that you can also not exercise it. You are not compelled, you are not obliged to be able to get it. If you're looking at your shares from a, say, like a pizza pie, if you don't exercise it, your stake becomes smaller percentage wise, because those that would exercise it would now have a larger stake, the much larger pie. So you may ask, why would companies do an SRO? It's one way for them to be able to raise money. If you've read my books, sat down in any of my keynote speaking engagements, or watched any of my videos, I would always say this, that the entire context or the entire narrative of the stock market on why companies would be there is they want to raise money. They want to get capital that they could use also to run the business or to grow the business or to make the business even bigger, better, stronger. So the reason why an SRO is there is basically for companies to be able to get additional capital. For investors, the only thing that makes it interesting is that you get it at a cheaper price. Is it worth buying? The fact that you own the stock and you are a long-term investor, it may actually mean that also that there must be something in the fundamentals of the company of that particular stock. That's why you entered the position. That's why you went into it. That's why you actually bought it. The question now is this: if you bought the stock based on its fundamentals and you like it based on how good the business is, then it should be also the same reason also if you analyze the company. Now, if nothing has changed in its fundamentals by the time that it's being offered, and all of the things that you like about the company as a long-term investment is still there, and everything seems to check, there's nothing that's a red flag as an investor right now, then by all means, for those that are very, very sensitive in valuations, one thing that you need to consider is the price that the SRO is offered. You compare it from maybe from a PE ratio standpoint or a price to book standpoint. Is this a price that if I buy it here from a PE or PB ratio standpoint, it's still cheap? Because you could define what works for you. So if at that point it's cheap, then you still like the company, then it could be a decision for you to deploy capital and subscribe. Stock prices could go up. As it goes up, even if they make an SRO at a lower price, from a valuations perspective, it may not be at the point where you want to buy it. If it's not at your buy price, from an SRO perspective, using valuations, PE, PB ratio, then maybe it's not worth getting into. One thing you can consider is this: if the SRO is somewhere around 1,600, check out what their dividends is, and if the dividend yield is something that's attractive to you already, then maybe it's worth getting into. So, giving you different options, but if you notice it, it will always boil down, it will always go back to the fundamentals, to the main reason on why you bought the company, on the main reason on why you're positioned, and it will always go back to the reason that is it actually cheap if you're buying it right now. To wrap this all up, SRO is an ability for you to buy it lower than the market price. It's only based on the shares that you have, and it's on a proportion from the shares that you have, and it's only limited to those that own the shares. Since it's an SRO and they're trying to raise money off of it, it will only be for a limited period. So go to your brokerages. They will have portions, especially if it's online, where you just have to put in the number of shares or the amount that you would want to subscribe to. Make sure that you have enough capital for that if you would want to subscribe. That's basically it. It's a very, very straightforward application. How will the price be over the next days, weeks, months after that? No one knows. No one has a crystal ball on how it will perform. I highly implore you to get it from the basis of, do you like the company? Is it cheap right now? Has the narrative of that entire investment changed? If it hasn't changed a bit and you still like it and you think it's cheap and you still want to be long-term in the company, by all means decide based on the conviction that you have. I hope you guys got a lot from this. I hope that this was something that was insightful. This was helpful for all of you. If you want more about the stock market, check out my videos in the description. If you want to read my books, it's also down below. And like, share, subscribe, and smash the bell so you get updated every time I come up with new content about investing. So that's it for now. Marvingermo. I hope this video helps you trade well, trade strong, trade smart. See you all again soon, and God bless you all.